Most people think this is a story about oil. It is not. Oil is only the surface. The deeper story is about power, leverage, and the financial plumbing that has held the modern world together for more than half a century. When a country changes how it sells oil, it is not only making an energy decision, it is making a monetary decision, it is choosing what currency it trusts. It is choosing which financial system it wants to sit inside. It is choosing whose debt it will hold, whose assets it will buy, whose military protection it will rely on, and whose pressure it will tolerate. That is why the latest move by the United Arab Emirates matters so much. The UAE, one of the founding members of OPEC since 1967, has announced that it is leaving OPEC and OPEC+, effective May 1st on the surface. The explanation is technical. The UAE says the move will give it more flexibility to meet changing demand. That sounds like an energy policy statement. But the timing tells a different story. This is happening while the Iran war has triggered a global energy crisis. The Strait of Hormuz is still effectively disrupted. Oil prices have moved above $100 per barrel gasoline. Prices are hitting record highs, Gulf economies are under stress, dollar funding pressure is rising, and now, one of America's closest Gulf allies is openly warning that if it runs short of dollars, it may be forced to use yuan or other currencies. That is not a normal headline, that is a signal for the first time in a very long time. One of the closest allies of the United States is essentially saying, if you cannot provide us with the dollars we need, we have other options. That sentence may sound like a technical funding issue, but it is much bigger than that. The UAE is not only talking about currency preference, it is talking about leverage. It is saying that it owns large amounts of US assets, and if it runs short of dollars, it can sell those assets. If enough Gulf states sell us assets at the wrong time, that can destabilize American markets. The US Treasury understands this. That is why the conversation around dollar swap lines matters so much. When Treasury officials say swap lines are needed to maintain order in dollar funding markets and prevent a disorderly sale of US assets, they are saying something very important. They are admitting that Gulf allies hold enough American assets, that if those assets were dumped into the market, the United States could feel it. The Gulf Cooperation Council countries collectively hold more than $2 trillion in US assets, according to the source. That is not pocket change, that is enough to create real financial stress if sold suddenly. So the relationship has changed for decades. The United States had leverage over oil producers because the dollar was the center of the oil trade and the US military was the security guarantor. But now, the Gulf states also have leverage over the United States because they hold American financial assets and the US cannot afford a disorderly sale. This is how systems change. Not all at once, not through one dramatic announcement. But when the leverage begins shifting, the UAE's warning was simple in practical terms. If dollar reserves get squeezed because the war disrupts oil revenue, and if the Gulf cannot earn the dollars it normally earns through oil exports, then it may need to raise dollars by selling us assets. Or it may start pricing oil in yuan or other currencies. Both outcomes challenge the old system. The US response was also simple in practical terms. Please do not sell the assets. Please do not create disorder in dollar markets. We can provide swap lines, we can get you the dollars. That is the real negotiation, not the public language, the underlying exchange. The Gulf says, we need dollars, and we have alternatives. The United States says, we will provide liquidity so you do not sell our assets. That is a monetary negotiation under pressure. Now, there is another part of the story that looks like a distraction but still fits the pattern. While this dollar pressure is unfolding, there is talk from the president about taking over Cuba almost immediately, even sending an aircraft carrier offshore as a show of force. That may sound unrelated, but in a world where the dollar system is under pressure, military power, geopolitical spectacle, and monetary stress often appear together. A country with reserve currency power does not only rely on money, it relies on credibility, military credibility, financial credibility, alliance credibility. The problem is that all three are now being tested at the same time. And to understand why, we have to go back more than 50 years. In 1971, President Nixon closed the gold window. Before that, foreign governments could convert dollars into gold under the Bretton Woods system after Nixon's decision. The dollar was no longer backed by gold. It became a fiat currency backed by the credibility of the United States rather than by a metal that could be redeemed. That created an obvious problem if you are an oil-producing country sitting on a finite resource. Why would you sell that real resource for paper money that another country can create in unlimited supply? Oil is finite, dollars can be printed. If you own oil, you understand that difference very clearly. The oil-producing nations were not foolish. They were not going to sell scarce energy for a currency with no anchor unless they received something valuable in return. So in 1974, Henry Kissinger went to Saudi Arabia and helped create the foundation of the petrodollar system. The basic arrangement was this. Saudi Arabia would price its oil in US dollars. Those dollars would be recycled back into US Treasury bonds in return. The United States would provide military protection and weapons. This deal was not fully transparent to the public at the time. It was hidden behind diplomacy and rumor for decades. But the structure eventually became clear. Saudi Arabia would sell oil for dollars. The world would need dollars to buy oil. The oil dollars would return to the United States through Treasury purchases. The United States would get permanent global demand for its currency and debt. Saudi Arabia would get military protection. That was the petrodollar machine. And it was an extraordinary deal for the United States because if every country in the world needs oil and oil is priced in dollars, then every country needs dollars. That creates structural global demand for the dollar. The dollar does not need gold backing if oil creates demand for it. Oil becomes the new anchor, not a legal gold anchor, a geopolitical energy anchor. The United States could run deficits, issue debt, and still find buyers because the world needed dollar reserves to function in global trade. Foreign central banks held dollars, oil exporters recycled dollars into treasuries, the U.S. Treasury market became the center of global finance. This is the architecture of American financial power. OPEC played a key role in that system. OPEC was the cartel that managed oil supply and pricing discipline among major producers. It helped maintain the oil pricing system. It helped keep oil markets stable enough and dollar-based enough for the petrodollar structure to function. In a world where the dollar is not backed by gold, a stable dollar-based oil system becomes extremely important. That is why OPEC mattered beyond energy. It was not only about oil supply, it helped support the dollar's global role. But now the logic is being challenged. The dollar is pure fiat. Trust in U.S. policy is lower. U.S. debt is much larger. Foreign reserves have been weaponized. China has built alternative systems. Gold has become more attractive to central banks. And Gulf states are beginning to test whether they must remain entirely inside the old dollar oil system. That is why the UAE leaving OPEC matters. It is not only an institutional change, it is a crack in the old enforcement structure. The source argues that the petrodollar agreement with Saudi Arabia effectively expired in 2024 after 50 years. Whether people debated the media framing at the time, the deeper point is that the old assumption of automatic oil, dollar recycling is no longer as solid as it once was. Then the Iran war began. That is where the story becomes much more dangerous. The Strait of Hormuz handles about 20% of the world's oil and gas supply every day. Ships from Saudi Arabia, the UAE, Kuwait, Qatar, Iraq, and other Gulf exporters depend on that narrow passage to bring oil to global markets. If Iran closes or disrupts the strait, the export model of the Gulf states is damaged immediately. These economies are built around selling energy. Energy is their cash flow. Cash flow creates dollar reserves. Dollar reserves support their currency pegs. Currency pegs support financial stability. When oil cannot move, the entire chain weakens. That is why this war is not only a military issue. It is a dollar funding issue. Saudi Arabia gives us a clear example before the war. Saudi Arabia needed oil around $100 per barrel to cover basic government spending, imports, and social programs. It was exporting close to 7 million barrels per Dalton Y. But if exports are disrupted, the math changes dramatically. If fewer barrels are sold, the price per barrel must be much higher to generate the same revenue. According to the source, one economist estimated that Saudi Arabia might need oil around $170 per barrel to generate the same revenue under the disrupted conditions. But paper oil is not at $170. It is over $100, but not enough to solve the Gulf revenue problem. The result is that Saudi Arabia and other Gulf states are under financial pressure. They are borrowing externally. The source says Saudi external borrowing has reached more than $100 billion over the trailing 4 quarters, a historic level that is remarkable. The world's biggest oil exporter is borrowing dollars to survive. That sentence tells you how distorted the system has become. The old petrodollar system depended on Gulf states exporting oil, earning dollars, and recycling those dollars into US assets. Now the Gulf states may not be earning enough dollars because oil movement is disrupted. Their dollar reserves are under pressure, their currencies are pegged to the dollar. To defend those pegs, they need large dollar buffers. If the buffers fall too much, the peg becomes vulnerable. If the peg becomes vulnerable, the entire domestic financial system becomes vulnerable. That is why dollar swap lines matter. The Gulf needs dollars. The US does not want them selling us assets. So the US provides dollar liquidity. This is not generosity, it is mutual leverage. The Gulf says, give us dollars or we may sell assets or move toward Yuan. The United States says, take the liquidity and do not destabilize our markets. That is the negotiation. Now, where does China fit into this? China has been patient. It has built real capacity for years. Copper mines, rare earth processing, ports payment systems, industrial production, commodity relationships, yuan settlement channels, alternative financial plumbing alongside the dollar system. Then, while the Gulf states are under pressure, the UAE Crown Prince meets personally with Xi Jinping. The UAE and China signed the 24th of September area trade and investment deals, aiming to push trade above $100 billion. Soon after that, the Wall Street Journal reports the yuan threat, then the US moves toward swap lines, then the UAE announces it is leaving OPEC. That sequence matters. The UAE locked in the China relationship first, then it went to Washington with leverage. It was effectively saying, we have another door. What are you willing to offer? That is how a smaller power negotiates with a larger power when the system is under stress. You do not need to defeat the United States militarily. You need alternatives. China is building those alternatives. The United States still has enormous financial power, but China has physical leverage. It makes things, it controls large parts of rare earth mining and an even larger share of processing. Those rare earths and tungsten are critical to missile interceptors, fighter jets, precision, guided weapons, electronics, and military production. The US military cannot fight with paper assets. It needs materials, It needs supply chains, it needs industrial capacity, and right now, the United States depends heavily on China for key inputs. This is why the war is exposing something deeper than military strength. For 50 years, the United States operated as if financial dominance could substitute for production, print dollars, issue treasuries, recycle capital through markets, buy what you need from the world that worked when the world was willing to accept dollars and provide goods. But if the world begins questioning the dollar and China controls the production base, then the US discovers that money is not the same as capacity. You cannot print missiles. You cannot print rare earth processing. You cannot print shipbuilding. You cannot print oil flows through a closed strait. You can print dollars. But if the other side controls the physical bottlenecks, dollars become less powerful. That is the structural problem. The United States is financially powerful, China is industrially powerful, the Gulf is energy powerful, and now those powers are colliding. This is why the dollar is losing part of its monopoly position. In 2001, the US dollar made up about 72% of global foreign exchange reserves. That meant nearly 3/4 of the world's financial safety net was held in dollars today. That share is in the 50s. The dollar is still the largest reserve currency by far, but it is no longer the same monopoly. What is replacing it? One answer is gold. Central banks have been buying gold at the fastest pace in about 50 years, according to the source. Gold now represents a larger share of certain reserve comparisons than Treasury bonds on an adjusted basis. The institutions that are supposed to be the most conservative financial actors in the world are choosing to hold more gold. Why? Because Treasuries lost some trust. A major turning point was the freezing of Russia's foreign exchange reserves in 2022, when the United States and its allies froze Russian reserves. Every central bank in the world learned a lesson. If your reserves are held in dollars and treasuries, they are only yours as long as the US system allows them to remain yours. That changed the risk calculation. A treasury bond is not only an asset, it is also a political exposure. If you can be sanctioned, frozen, or cut off, then your reserve asset is not neutral, it is conditional. And if reserve assets become conditional, central banks will diversify. Gold is attractive because it is not someone else's liability. A treasury bond is a claim on the United States government. Gold is a physical asset, it has no issuer, it cannot default. It can be stored outside the dollar system. That is why central banks are buying it, not because they think gold is fashionable, because they want reserves that cannot be frozen by a foreign power as easily as dollar assets can be. This is the dollarization process, slow, uneven, but real. And China has been building the alternative plumbing. Yuan clearing banks now operate in London, Dubai, Singapore, Hong Kong, Switzerland, and other key financial centers. Commodity transactions are increasingly being experimented with outside the dollar system. Iran has sold oil to China in yuan for years. India has experimented with non-dollar settlement. Russia moved away from dollars after sanctions. Major mining and commodity firms have begun signing yuan-linked arrangements with Chinese buyers. The alternative is not theoretical anymore. It exists. It is not yet dominant, but it exists. That changes bargaining power. The dollar remains powerful because the treasury market remains deep, liquid, and globally central. But if trust weakens, investors demand a higher interest rate to hold us debt. That is exactly what rising treasury yields represent. If I trust you less, I do not necessarily refuse to lend to you. I may simply demand more compensation, pay me more, give me a higher yield. That is the bond market's message. In the source, the 10-year treasury yield around 4.4% becomes an important pressure point. Each time yields approach that level during the Iran crisis, political behavior shifts, threats soften, ceasefires are extended. Talk of peace returns, the bond market starts influencing foreign policy. That is not an exaggeration when a government depends on borrowing. The bond market has power. If yields rise too much, debt service becomes expensive. Treasury market functioning can weaken. Financial conditions tighten, stocks fall, credit markets become stressed. The government's room for action narrows. This is why the bond market can restrain war policy. A country may have military power, but if the cost of debt rises too much, the financial system pushes back. That is the modern version of discipline, not gold discipline, bond market discipline. And right now, the bond market is watching three things at once: energy prices, inflation, and U.S. fiscal credibility. The U.S. Treasury can provide dollar liquidity to Gulf states through swap lines that may stabilize dollar funding markets in the short term. It may prevent disorderly asset sales. It may calm the Treasury market. But if the Strait of Hormuz remains closed or disrupted, adding more dollar liquidity can also turbocharge commodity inflation. More dollars chasing constrained energy, food, fertilizer, and physical goods can increase price pressure that creates a dilemma. Provide liquidity and risk inflation. Withhold liquidity and risk disorderly asset sales or dollar funding stress. This is the trap. Scott Bessent in the source's framing is buying time. The swap lines can stabilize the short term, but they may create a larger inflation problem later. If the war does not end, this is the essence of the crisis. The United States needs to maintain order in dollar markets, but the physical economy is constrained by energy and supply chains. Financial liquidity cannot create oil flows through Hormuz. It cannot create fertilizer shipments. It cannot create missiles without rare earths. It cannot create trust after reserves have been weaponized. Liquidity buys time. It does not solve the physical bottleneck. This is why the war is economic more than military. Iran understands this. China understands this. The Gulf states understand this. The United States is facing pressure on multiple fronts. If Iran keeps the strait closed, the Gulf states lose export revenue and dollar reserves. They pressure the U.S. for liquidity. The U.S. provides liquidity to prevent asset sales. Liquidity may stabilize markets temporarily, but increases inflation pressure. Inflation pushes bond yields higher. Higher yields constrain U.S. policy. China supplies Iran indirectly, buys oil, controls critical materials, and offers Yuan settlement alternatives. That is a systems war, not only a battlefield war. Now, how does this end? The source gives two broad paths, and neither is comfortable in the first path. Iran collapses or breaks, but if that happens, Iranian oil may go offline for a long time. Oil spikes, energy inflation rises. The global economy slows. Bond markets face pressure, a recession risk increases. In the second path, the global supply chain breaks before Iran does. Hormuz stays constrained. Food inflation rises. Fertilizer flows are disrupted, commodity inflation spreads. Bond markets revolt against inflation. The U.S. faces recession pressure anyway. So either Iran breaks and supply is damaged, or supply chains break before Iran does. Both create inflation and recession risks. That is the danger. The U.S. strategy appears to be extending ceasefires and blockading Iran into submission, assuming Iran will break first. But Iran has allies. Russia can support it. China can buy its oil. The simple strategy of keeping Hormuz constrained can create pain across the global economy. And the fertilizer issue may be even more dangerous than oil. The Strait of Hormuz handles roughly a third of the world's fertilizer trade, according to the source. Fertilizer is not optional. Synthetic nitrogen fertilizers support food production for billions of people. If fertilizer flows are disrupted, food inflation may rise later, even if consumers do not feel the full impact immediately. Oil shocks hit transportation first. Fertilizer shocks hit food later. That lag matters. Fuel costs are already pushing food inflation higher. Fertilizer disruption may not have fully reached the consumer yet. If Hormuz remains disrupted for months, the food price effects can become much more severe. Congress has been briefed that clearing mines in Hormuz could take another 6 months, according to the source. 6 months of disrupted oil and fertilizer flows would be very damaging. This is why the market may be too optimistic. The market seems to be pricing two assumptions. First, that artificial intelligence productivity will lift growth and profits. Second, that the Iran war will end quickly enough not to break the system. If either assumption is wrong, valuations can change dramatically. Now we need to talk about stocks. The source mentions a version of the Warren Buffett indicator adjusted by federal debt. The traditional Buffett indicator compares total stock market capitalization to GDP. It asks whether the value of the stock market is high relative to the size of the economy. The adjusted version subtracts federal debt from GDP or otherwise adjusts for the fact that in an era of massive government debt and money printing, the relationship between market capitalization and the real economy is distorted. Using that adjusted metric, the source identifies 3 moments in the last 70 years where the indicator rose above 100% of GDP: the dot-com bubble peak. In 2000, the everything bubble peak in 2021, and now in the previous 2 cases, markets fell between roughly 25 and 47% from peak to bottom and took between 2 and 13 years to recover. That does not mean the same exact outcome must happen. Now, markets do not repeat mechanically, but it tells us that valuations are stretched at a time when macro risks are elevated. That is the dangerous combination. High valuations are manageable if the world is calm and growth is strong. Energy shocks are manageable if valuations are low and balance sheets are strong, but high valuations plus energy shock plus treasury market pressure plus de-dollarization plus war plus supply chain risk is a much more fragile setup. That is why I would be cautious. The market is pricing perfection. It is pricing an AI productivity boom. It is pricing a quick end to the Iran war. It is pricing manageable inflation. It is pricing stable bond markets. It is pricing the dollar system surviving the stress. It is pricing Gulf states not selling us assets. It is pricing China not tightening critical material leverage. It is pricing a smooth world, but the world may not be smooth. If any of those assumptions break, the market may have to reprice. That repricing can be sharp. Now, what does this mean for portfolios? First, I would not ignore cash. Cash is not always a long-term wealth builder, but in moments of high uncertainty and stretched valuations, cash has option value. Cash lets you survive volatility. It lets you buy when markets fall. It reduces forced selling. It provides psychological stability. The source says the speaker holds more cash than usual but remains invested. That is a balanced posture. Not all in, not all out, cautious but not frozen. That makes sense in a world where the upside story is real, but the downside risk is also real. Second, I would pay attention to gold. Gold tends to perform well when trust in the dollar system weakens. When central banks diversify reserves, when Treasury credibility is questioned, and when geopolitical stress rises. In the prior periods when the adjusted valuation indicator was extreme, gold performed well relative to stocks. That does not guarantee future results, but it fits the logic of the current system. Central banks buying gold at the fastest pace in decades is not random. It is a signal they are reducing dependence on U.S. Treasuries and increasing exposure to neutral reserve assets. An ordinary investor does not need to copy central banks exactly, but should understand what they are signaling. Third, I would be cautious about the dollar. The dollar is still the largest reserve currency. It is not disappearing tomorrow. It remains deeply embedded in trade, finance, debt, and global markets. But reserve share has declined from the 70s to the 50s. Trust has been damaged by sanctions. Alternative payment systems exist. Yuan commodity settlement is growing at the margin. Gold reserves are rising. The process is slow, but the direction matters. A reserve currency can remain dominant while losing monopoly power. That is what appears to be happening. Fourth, I would watch oil and energy. If Hormuz remains constrained, oil prices can remain high or move higher. High oil pressures, inflation, consumers, corporate margins, central banks, and bond yields. Energy is not a side sector. It is the base of the real economy. Fifth, I would watch fertilizer and food. Food inflation can be politically destabilizing. It hits every household. If fertilizer shortages arrive later, the full effect of the Hormuz disruption may not be visible yet. Markets may underestimate lagged food effects. Sixth, I would watch Treasury yields. If the 10-year yield moves above levels that create stress, policy may shift. The bond market can force de-escalation or liquidity support. But liquidity support can worsen inflation if physical supply is constrained. This is the loop. Now we need to be careful not to turn this into a prediction of immediate collapse. The dollar system is not ending in one day. The U.S. is still powerful. The Treasury market is still central. The U.S. military is still dominant in many dimensions. The American economy is still innovative. The AI boom may be real. Markets can stay expensive longer than cautious people expect. Wars can de-escalate. Hormuz can reopen. Oil can fall. Gold can correct. China has its own problems. The yuan is not ready to replace the dollar overnight. All of that is true, but a system does not need to collapse overnight to change. Reserve currency systems degrade gradually, then suddenly around moments of stress. The current stress is revealing the direction. Gulf states have alternatives. China has built infrastructure. Central banks are buying gold. Treasury buyers want higher yields. Dollar swap lines are needed to keep allies from selling assets. Oil and fertilizer choke points are pressuring inflation. That is enough to change portfolio thinking. The correct response is not panic. The correct response is preparation. That means understanding what assets benefit from which scenario. If the war ends quickly and inflation cools, stocks may continue to do well, oil may fall, gold may pause, cash may underperform. If the war drags on and Hormuz remains disrupted, oil and gold may do better, inflation may rise, bonds may struggle, and stocks may sell off. If the Treasury market becomes disorderly, the Fed and Treasury may intervene with liquidity that may support markets in nominal terms but weaken purchasing power. If de-dollarization accelerates, hard assets and non-dollar reserves may gain importance. If AI productivity truly accelerates enough, it may offset some macro pressure, but that is a high bar. A portfolio must survive multiple futures. This is why diversification matters more now. Not the shallow kind of diversification that owns many stocks, all exposed to the same U.S. liquidity cycle. Real diversification, cash for optionality, stocks for long-term growth, gold for monetary disorder, energy exposure for supply shocks, maybe Bitcoin for those who understand its risk profile and see it as digital scarce collateral, Treasury exposure with caution around duration. Global assets with awareness of currency risk. No single asset solves everything. The world is becoming more multipolar. Portfolios should not be built as if one system is permanent and unchallengeable. Now let us return to the UAE. Leaving OPEC is symbolic and practical. Symbolically, it weakens the cartel that helps sustain the old petrodollar oil order. Practically, it gives the UAE more flexibility to manage production, trade, and relationships. It can maneuver between the United States and China. It can ask for dollars while building yuan trade links. It can hold us assets while threatening to sell them. It can remain a U.S. ally while increasing Chinese economic ties. That is the new world. Allies hedge, partners diversify. Countries do not want one patron, they want options. The United States used to provide the best combination of security, liquidity, market access, and reserve currency stability. It still provides much of that, but it no longer provides it without question. Countries have seen reserves frozen, they have seen dollar debt weaponized, they have seen China offer industrial capacity and alternative settlement, they have seen gold rise in importance, so they hedge. That is rational. The UAE is not simply betraying the United States. It is responding to incentives. When you understand incentives, you stop being surprised. The Gulf needs dollars today. It may want yuan optionality tomorrow. It wants us military protection. It wants Chinese trade. It wants to avoid selling us assets disorderly. It wants leverage over Washington. That is the system. Now, how does the United States respond? By providing swap lines, diplomacy, military pressure, and attempts to keep allies inside the dollar system. But every support mechanism has a cost. Swap lines can stabilize funding markets, but they expand dollar liquidity. Military pressure can signal strength, but it can also consume munitions and expose supply chain weakness. Diplomacy can calm bonds, but it may look like backing down if driven by yield pressure. The U.S. is trying to maintain order in a system where the physical and financial pillars are both under stress. This is difficult. The bond market is watching. The oil market is watching. The gold market is watching. China is watching. The Gulf is watching. Investors should be watching too. Now let us talk about Bitcoin because the source mentions it as part of the portfolio impact. Bitcoin often behaves differently in different environments. Sometimes it trades like a risk asset, sometimes it trades like digital scarcity. In a dollar distrust environment, some investors may see it as a hedge against fiat debasement. In a liquidity crisis, it may fall with risk assets. So Bitcoin is not simple. If liquidity is injected to calm dollar markets, Bitcoin may benefit from monetary expansion. If risk markets crash first, Bitcoin may suffer before recovering. If capital controls, sanctions, or reserve diversification become bigger themes, Bitcoin's narrative may strengthen. But volatility is extreme. So Bitcoin can be part of the new monetary conversation, but it should be sized with respect for risk. Gold is central bank money. Bitcoin is market-native digital scarcity. They are not the same, but both can benefit from distrust in fiat systems under certain conditions. Again, know what you own. Now let us talk about the dollar itself. The dollar's role is not only about confidence, it is about network effects. Most global trade, debt, commodities, financial contracts, reserves, and payments still involve dollars. That network cannot be replaced overnight. Even countries that dislike us power often still use dollars because the system is deep and liquid. But network effects can weaken at the margin. If more oil trades in yuan, if more commodities settle outside dollars, if more central banks buy gold, if more countries build payment rails outside SWIFT, if more Gulf states demand swap lines, if Treasury yields must rise to attract buyers, then the dollar remains dominant but less comfortable. That is the transition phase, a dominant system under stress. Not dead, not invincible. That is where we are. Now, markets often misprice transition phases because people like binary thinking the dollar is either safe or dead. Stocks are either fine or crashing. China is either winning or collapsing. Oil is either temporary or permanent. Real systems are more nuanced. The dollar can remain dominant while losing share. Stocks can remain in an uptrend while downside risk builds. China can have domestic weaknesses while gaining strategic leverage. Oil disruption can be temporary but still cause major inflation before it ends. Gold can rise because trust is falling, not because the world ends. This is why simplistic narratives fail. We need to think in probabilities and chains. Now the chain in this story is clear. Nixon closed the gold window. The dollar needed a new anchor. The US and Saudi Arabia built the petrodollar system. Oil created structural demand for dollars. OPEC helped manage the oil dollar order. The old agreement weakened or expired. The Iran war disrupted Hormuz. Gulf states lost oil revenue and dollar inflows. Dollar reserves came under pressure. The UAE warned about using yuan or selling assets. The US considered swap lines to prevent disorderly US asset sales. China deepened Gulf ties and offered alternatives. Treasuries lost some trust after reserve weaponization. Central banks bought gold. Treasury yields rose as investors demanded more compensation. Bond markets began constraining US policy. Oil, fertilizer, and supply. Chain disruptions threatened inflation. Stock market valuations remained high. The market priced perfection, and portfolios became exposed to a major repricing if the assumptions fail. That is the causal chain. That is what the headline hides. Now, what should an investor do emotionally? Do not become addicted to crisis. Crisis narratives can be seductive because they make people feel smarter than the crowd. But if you go too far, you can sit in cash for years while markets rise. You can over-own hedges. You can miss growth. You can mistake caution for wisdom. At the same time, do not ignore warning signs because the market is still rising. Markets often rise late in a cycle because liquidity, optimism, and momentum persist. The fact that prices are high does not prove risk is low. The correct approach is balance. Stay invested but more carefully. Hold more cash than usual if valuations and macro risk justify it. Own some assets that benefit from monetary distrust. Watch energy and inflation. Avoid overconcentration in one story. Be ready to buy if markets reprice. That is not fear. That is preparation. Now let us think about the phrase, the end of the petrodollar. The petrodollar system may not end in one dramatic announcement. It may end through gradual weakening. First, the formal or informal agreements lose force. Then more trade happens in non-dollar currencies. Then reserve managers diversify into gold. Then oil producers demand swap lines instead of simply recycling dollars. Then China builds parallel settlement. Then Treasury buyers demand higher yields. Then the dollar remains dominant but no longer unquestioned. That is already a kind of end, not the end of the dollar, the end of the automatic dollar oil monopoly. That is enough to matter. Reserve systems are built on trust and habit. When habit changes, the system becomes less stable. When trust changes, the system becomes more expensive to maintain. The United States can still maintain the dollar system, but it may have to pay higher rates, provide more liquidity, use more military pressure, and tolerate more inflation. That is a cost. The old system gave the US extraordinary privilege. The new system may still give privilege, but with more friction. That friction is what markets are beginning to price. Now let us return to the Gulf asset issue. If the GCC holds more than $2 trillion in US assets, those holdings are both an anchor and a weapon. They anchor Gulf states into the US system because selling them would hurt their own portfolios, but they are also a weapon because threatening to sell them creates pressure on the United States. This is mutual dependence. The US needs Gulf states not to dump assets. The Gulf needs the US to provide dollar liquidity and security. China offers an alternative relationship that is the multipolar system. In a unipolar world, the US dictates. In a multipolar world, allies negotiate harder. That is what we are watching. Now let us talk about paper oil price suppression, as described in the source. The claim is that paper futures markets can suppress or distort the price of physical oil. Whether one accepts the full framing or not, there is a real distinction between paper prices and physical availability. Futures markets can reflect expectations, positioning, hedging, and liquidity. Physical markets reflect barrels, shipping, insurance, storage, and refinery demand. In a crisis, the gap between paper pricing and physical stress can become important. If paper oil is $100 but physical exporters need $170 to balance their fiscal needs under disrupted volumes, then financial pricing may not reflect the full economic pain in producer countries. That pain creates borrowing needs. Borrowing needs create dollar demand. Dollar demand creates swap line pressure. Again, the oil price is not only an energy number, it is a fiscal number for producer states. It is a dollar funding number. It is a geopolitical leverage number. Now, food inflation. Fuel affects food through transportation, farming, processing, and distribution. Fertilizer affects food through crop yields. If fertilizer trade is disrupted, the price effects may arrive with a lag. Farmers make planting decisions, input prices change, production changes, food prices follow later. That lag can fool markets. Markets see current food inflation and think they understand the shock. But if fertilizer disruption has not fully flowed through, the next wave may still be ahead. This is why Hormuz is so dangerous. It is not only oil, it is the input chain for food. And food inflation is politically explosive. Governments can tolerate many things. Hungry populations are different. That is why the energy crisis can become a political crisis. Now, let us look at the two bad endings again. Iran collapses and oil is offline for a long time, or the supply chain collapses before Iran does. Both are bad because both hit inflation and growth. In the first, supply loss is direct. In the second, supply chain disruption spreads. Either way, bond markets face a bad mix, slower growth and higher inflation. That is stagflationary pressure. Stocks generally do not like stagflation. Bonds do not like inflation. Cash loses purchasing power. Gold can benefit, energy can benefit. Real assets can behave differently from financial claims. This is why portfolio construction must consider stagflation. For much of the last 40 years, investors lived in a disinflationary world. Falling interest rates helped bonds and stocks. Globalization lowered costs. China produced cheap goods. Energy was mostly available. Central banks could cut rates in downturns. That world is changing. If supply constraints, war, dollarization, and fiscal deficits dominate, the old 60 divided by 40 assumptions may not work the same way. That does not mean abandon stocks and bonds. It means understand the regime. Regime matters. A portfolio built for the last 40 years may not fit the next 10. Now let us talk about gold relative to stocks. The source says that in prior periods when the adjusted valuation indicator was above 100% of GDP, gold performed well relative to the stock market. That fits the idea that when financial assets are expensive and monetary trust is under pressure, gold can serve as a store of value and hedge. Gold is not productive in the same way a business is productive. It does not pay dividends. It does not innovate. It does not grow earnings. But it does preserve monetary optionality. It is a reserve asset outside the liability of a government. That is why central banks buy it. An ordinary investor should not view gold as a get-rich-quick asset. It is a form of insurance against monetary disorder and financial repression. It may underperform during strong equity bull markets. It may shine during trust crises. This environment has trust crisis characteristics. That is why gold deserves attention. Now, let us talk about the stock market. The market can remain irrational longer than cautious investors expect. If AI earnings are strong, if the war ends, if inflation cools, if bond yields stabilize, stocks can continue rising. So being entirely out of the market can be dangerous. That is why the source posture of holding more cash than usual but still being invested is important. You want protection against downside, but you do not want to completely abandon upside. The hardest part of investing is living in uncertainty. You never get perfect clarity. You build a portfolio that does not require perfect clarity. That is the principle. Now, let us talk about what would make the risk decline. If Hormuz reopens sustainably, if tanker insurance normalizes, if Gulf exports resume, if Saudi borrowing pressure eases, if dollar reserves stabilize, if the UAE steps back from Yuan oil threats, if Treasury yields fall without massive inflationary liquidity, if food and fertilizer flows normalize, if China eases rare earth pressure, if central banks slow gold accumulation, if market valuations reset, if the Iran war ends without major oil infrastructure damage, those would reduce the stress. Until then, the risk remains. Now, let us talk about what would make the risk worse. Hormuz remains closed for months. Oil rises sharply. Fertilizer shortages appear in food prices. Gulf states sell us assets or threaten more aggressively. Treasury yields break higher. Dollar swap lines expand. Inflation expectations rise. The Fed is forced into a bad choice between inflation and financial stability. China tightens rare earth exports. More commodity deals move into yuan. Gold accelerates. Stocks continue pricing perfection while risks worsen. That would increase fragility. Investors should watch those signals. Not only headlines, signals, flows, prices, yields, reserves, policy reactions. Now let us close with the deeper lesson. The petrodollar system was never only about oil. It was a way to give the dollar a new anchor after gold was removed. Oil created constant global demand for dollars. Treasury recycling allowed the U.S. to borrow cheaply. Military protection maintained the security arrangement. OPEC helped manage the system. That system made the United States extraordinarily powerful. But every system creates dependencies. The U.S. became dependent on foreign demand for treasuries. The Gulf became dependent on dollar inflows. China became the manufacturing base. The world became dependent on choke points like Hormuz. Central banks became dependent on dollar reserves. And now, under the stress of war, energy disruption, and financial weaponization, those dependencies are being exposed. The UAE leaving OPEC is not the entire story, it is a symptom. The Yuan oil threat is not the entire story, it is a symptom. The swap line request is not the entire story, it is a symptom. Rising treasury yields are not the entire story, they are a symptom. Central banks buying gold are not the entire story, they are a symptom. The real story is that the old monetary order is being renegotiated under pressure. That is what investors need to understand. We are not watching an isolated oil crisis. We are watching a reserve currency system defend itself while its energy anchor, military supply chains, bond market, and geopolitical alliances are all being tested at the same time. That is why I would be cautious. That is why I would not ignore gold. That is why I would not ignore cash. That is why I would not ignore oil. That is why I would not assume stocks can price perfection forever. And that is why I would not treat the dollar as untouchable simply because it has been dominant for so long. Dominance can last longer than critics expect and then weaken faster than believers expect. The prudent investor does not need to predict the exact date of change. He needs to recognize when the system is becoming more fragile in position, so he is not destroyed if the change accelerates. That is the principle. The end of the petrodollar does not have to mean the end of America. It does not have to mean the end of the dollar. It does not have to mean immediate collapse. It means the end of a world where the U.S. could assume oil producers would automatically price in dollars, recycle surpluses into treasuries, and accept the dollar system without alternatives. That world is fading, a new world is forming. More gold, more yuan settlement, more bilateral commodity deals, more swap lines, more pressure on treasury yields, more inflation risk, more geopolitical bargaining, more volatility, more need for investors to understand the difference between paper claims and real assets. If you understand that, you will not be surprised by the next phase. If you do not, you may think the market is only reacting to oil prices, while the real system is being renegotiated underneath your feet. That is the danger. The headline says the UAE left OPEC. The real story says the petrodollar system is losing one of its old pillars. And when pillars weaken, the building does not always fall immediately. But the people inside should stop pretending the cracks are decorative.